Hi, welcome to the Market Alert for Monday, the 6th of April 2020. So on Friday, oil jumps, stocks dump as helicopter money sends the USA risk soaring. And this is something I've spoken of before as well. Once you get into helicopter money, that poses all sorts of inflationary problems and risks. Obviously, the major one is that once you've started it, you can't stop. And talking of risks and bad news, let's have a look at the Forex factory for the Friday non-farm payroll employment change. And we spoke about this in Friday's alert about the 100k or minus 100k jobs, and you can see it was 7 times greater. You can see this on the graph here from the previous, where it had been pretty steady and then catastrophic, to say the least. However, if I scroll back here to about 2000 and let's just come back a bit more, 2006, you will see that this brings us into that sort of level of the 2008-2009. The only difference is this was slightly delayed. You can see that it sort of fell like a waterfall, whereas this, it's more of a failed lift shaft or lift in a lift shaft where, you know, the cables have been cut and the market dropping down very, very sharply there. This, of course, is only the start of what we're going to see record-breaking numbers on the non-farm. We're going to have to wait a month now until we get the news factored in and all of the other job losses. So, yeah, it's interesting to say the least. There's no doubts about it. It's going to be catastrophic, and already you could say that it is the greatest depression that we've ever seen. So let's have a look at the market's reaction to this. I'm recording this on a Sunday, so there's no live prices at the moment. The market had managed to work its way up before the news, then came down to the 200 MA and the BRN. The news came out, and as night follows day, you know, biggest ones for over 12 years, huge bad news, and the market moves up. What a surprise. What a surprise. So we get a double top here, and then we get a retracement as far as here is concerned. So from here, I can just get this to activate. There we go. From here down to here takes you to 76% retracement. I'll just redo that so you can see the figures. There you go. So back to 76% there. And then a close below the 20 bar moving average. Prices managed to come back above the 200 MA and then fail, stay below the DP. They come back to the DP and the 200 fail, and then we continue lower with the 20 bar moving average being then the benchmark of how much the market could actually rally. And then before the close, of course, you get the classic, let's bring the market back off the lows, which they managed to achieve, which you can see there. The implied volatility dropped on Friday, 49.25. This is more than a 50% retracement as well from the high. So given that what we're seeing here, which you could only interpret really, where we have really, really bad news and the market managed to move higher. Yes, it moved lower after, but it makes you wonder if we're actually starting to make some sort of progress back towards the highs. At the moment, the market has found support at the 38% retracement on several occasions at the moment, still below the 20 bar moving average and still not closing above the 5 bar moving average, which is the magenta coloured line here. But a close back above here could see prices move back up towards the 50% retracement. Are they going back to the all-time highs? I wouldn't have thought so just yet. I would have thought there was another down leg in this market. And retesting of the sort of lows that we see in the monthly chart, you know, down to this sort of area, back to 2017, if not 2015, before prices start to move higher. Also, the US dollar would be of interest as well to see. That would have to start moving down in order for prices to start breaking down in the stock market as well. In the colour-coded volatility, we can see that we're below the 20 bar moving average. We're on amber at the moment because prices haven't closed above the 20 bar moving average in the prices. Just to bring you up to speed on a few other things, Deutsche Bank had a bit of a rally recently, but that has run out of steam. We're now back below the $6 level. The close on Friday was $5.90. Watch the $3.90 level if prices continue to move lower. And also, of course, the recent low that we saw at, let's just get the low for you on this bar. The low was $4.99 that we saw a few weeks ago. One other thing that caught my eye as well, I'd mentioned this in last week's market alert about a bounce in crude oil, but wasn't expecting it to be so soon. Trump, again, in his inimitable style, decided to have a word with Russia and the Saudis and, about production. And all of a sudden you see crude oil go from $24 a barrel all the way up to $34, $10 increase, massive increase on Friday. But this will be short-lived, that's for sure. There's no way they're going to be able to hold this because of the global lockdown. The demand for crude oil is not there at the moment, not until the economy gets going again and everybody's released from their pens. So we'll have to wait and see. But there could be a good sell off this, to be honest with you, as it retests those lows going forward. So I'll keep an eye on this one as well. Okay, that will do it for this one. Like I say, I'm recording this on a Sunday. Unless there's something major happens overnight when the market's open, I will do an update. But otherwise, everything's sort of steady as she goes at the moment as we look around the charts. And again, 2 trillion stimulus helps to bring some sort of stability to the markets at the moment. The problem is when the money runs out, of course, and then they have to go back to cap in hand for more. So we'll see, but it's certainly not over by a long shot on the downside. But at the moment, like I say, it's being held because of the stimulus that we've already seen. In fact, let me just show you this, if I can pull this up quickly. Okay, this is what I wanted to bring up. This is the Fed's balance sheet up to date now, and you can see there 5.8 trillion in balance sheet figures now for the end of last week. So I'm going to keep this updated and show you this on okay, so I've got an up-to-date Fed balance sheet. The assets on the balance sheet, of course, they've got the opposite in liabilities. That's what a balance sheet's all about. 5.8 trillion as of Friday of last week. A huge amount. And what's interesting here is the vertical and parabolic explosion in this debt. This is going to increase. This doesn't include the 2.2 trillion that they've printed either. This is just the assets they're buying, corporate debt, mortgage debt, etc., etc., and anything they can buy and add to the balance sheet. Before it was just treasuries, now it's all sorts. They're really going for it. So we'll see how this pans out shortly. By the way, the repos obviously have gone quiet because the government now have printed a huge amount of money to offset these problems, and also the 700 billion a month QE, plus the 60 billion in T-bills. So yeah, let's keep an eye on this one, because as I said in the other market alert a few days ago, that 9 trillion by Christmas is the target. Okay, that's it for this one. As ever, thanks for watching. See you in the next one.